a big question mark, but it's a lot like when you think about Industrial Revolution, and you could say, did mechanized factories take away the labor? No, we were still there. We just went in different directions from what was done before as blunt force labor to more specialized labor. Yep. Certainly tasks such as programming could be easily obsolete. AI could take that. But the person who is programming, well, usually is an intelligent individual, yeah. And that intelligent individual may be better deployed somewhere else in society. They'll find another occupation. Yep. Because AI itself doesn't necessarily pose a threat of obsolete for a job. It actually, in many cases, will just be an enhancement to make the one employee far more efficient in being able to actually produce more, especially if it's intellectual side. Sure, yeah. Think about financial planning, the enhancements for financial planning. Instead of James and Steve and Luke and everyone else having to run calculations that almost feel like an abacus being utilized, AI could help them work through financial plans faster. The same thing, I have friends that work at NASA. Stuff that used to take computer programs half a day to generate calculations on outputs for trajectories and all modeling they were doing, they now can do within an hour using AI. Yep. Hasn't deemed their job obsolete. The other backside is, and I remember at least a few years ago here we even talked about it, which is we have as a society channeled young folks all into college at the expense of the skill side of the equation. And when you look at the United States, we have a drastic imbalance that you have all these younger folks with college degrees, but not necessarily jobs aligned with their degrees.
Right.
At the same time, we have 7 to 7.5 million open positions, not just, well, we think they exist. We literally have 7 million open vacancies for skilled labor in the United States without a person to even apply. So, to your point, some of this could be a guy who was doing programming could one day become an actual electrician. And trust me, you'll get paid well. Probably far better and better quality of life. Great. So the Fed meets today and tomorrow, and the whole sort of expectation is we'll see a rate cut, a small one most likely. So rates have been trending down. That should help the mortgage side of the equation. We're not sure how much though, because remember, 30-year mortgages are not based on the Fed funds rate, they're based on the 10-year Treasury further out. And that's been bumping along at 4%. So everyone keeps waiting for mortgages to come down in price, and cost is what I mean by that. Maybe we'll get a little bit of relief, we shall see. We need the bond market to cool off far more than what we are experiencing now. On inflation front, inflation came in pretty good the other day. So we're no longer at 9%, we're bumping along at 3%. A lot of people were worried the tariffs would actually cause more inflation. That hasn't yet happened, and it's partly because what I mentioned, that the pass-through cost of the tariffs really haven't materialized. So, plus when you look at 60% of the inflation number is services, housing is a part of that. Services has actually been a little bit cooling down thanks to shelter. So rents have been coming down. Home prices in a lot of metro areas have started to cool some. So that's certainly helped the numbers. And of course, if you fill up your car with gas, you would know gas has got a lot cheaper. And so that's another input that goes into inflation. So those are looking good. But they could always spike. For example, if tomorrow the Fed were to come out and say, we're cutting rates by 0.5%, and if they go on an aggressive rate cutting regime and we start going back down to 3% on the Fed's funds rate or lower than that, it's just free money. It's like throwing jet fuel on a match. We'd just see a lot more spending, a lot more borrowing, and that would just ramp up the inflation number. And when you have to think too about the tariffs, so they're probably not designed this way, but they are a foray into the United States having some version of what the rest of the Belt world has, which is a value-added tax on consumption. because we have to find new revenue, where our debt is reaching obviously new levels. Stock market's up, but so is the debt levels. I mean, for the next fiscal year, which we're already in, we'll be looking at about 1.2 trillion as the interest on the national debt. Currently, the tariffs are raising 32 billion a month, which is about a third of a trillion annualized.
That's just another tax on American consumers and businesses.
Correct. But what may be coming around the corner, but not directly around the corner, is we're getting exposure to the tariffs as a consumption tax, but hidden, not in your case, but hidden on the consumer side. Eventually, though, those tariffs won't be able to pay the bill that we really need the cash flow for, and you would start putting on a 5 or 10% value-added tax on the back end. So as an example, let's say this dress shirt is $60 on the rack, but whoever imported this dress shirt from Indonesia or China or wherever it gets made, probably only paying about $3 or $4 for this at the Port of Los Angeles. So the 10% or 20% tariff is getting hit at $3. So the tariff on this shirt, unlike your steel products, is like 60 cents, less than $1. That's why when you look at the stated tariffs on countries that have, say, 20% tariffs currently, the actual effective tariff, the rate, is less than 10%. And it's because only 20% approximately of the actual tariff is being pushed out to the consumer. Right now, the businesses are able to absorb the majority. Not in your case because of the math.
That's going to change.
Yeah, but the high volume stuff like consumer goods, we'll call it clothing and other small trinket items, etc. Toaster ovens would probably even fall in that category a little bit as well. Those have much larger margins, and as a result, the 10 or 20% tariff is just not as noticeable. But if you were to flip that around and say, let's have a 10% value-added tax, which is low, by the way, compared to Europe's VATs that they assess. Many of those countries have 20% VATs. Imagine now you have to pay a 20% VAT on a $60 shirt. That's $12 tax. So now my $60 shirt is $72.
Yep.
So that's the end game. Maybe a decade out from now, we have state and local sales taxes. Some states do, some don't. But I think we're headed long-term to a federal version. You can't tax income but so much. We already have a very aggressively progressive tax schedule. So they're going to look for other means of tax. So it'll be interesting to see if that comes down the pike. Any questions on that? No? Yeah, James.
So is that affecting, I guess in the more immediate moment, the tariffs, is that affecting the different companies that you guys are looking at in the portfolios?
Not as much, because a lot of our work is focused on the United States. And we do have international, but a lot of our international is Europe, some Japan, but most of those countries, it's interesting because Europe has actually benefited from the aggressive China taxes, well, tariffs, because the European tariffs are much lower than what we're applying to China.
Yep.
So European business is actually on an upswing, while the Chinese is, as you've highlighted, kind of in a gray spot. So it hasn't actually impacted the businesses that we're investing in. And some of those are tech businesses, of course, where the impact is not as big. One thing that may ultimately impact tech, but in a very small manner from an investment standpoint is, and this kind of goes to your point about your child, is within the tech sphere, we just increased the H-1B visa to $100,000 per year. So all these companies that are bringing folks in internationally to do IT jobs just got drastically more expensive. I live in Washington, D.C., where Data Alley, if you're not aware, is the largest concentration of data centers in the world. 70% of the entire world's internet traffic flows through Washington, D.C. So we have an enormous population of H-1B visa employees, and a lot of American IT people could never compete in that job space because the international folks were so much cheaper.
Yep.
Now that person coming from overseas has an extra $100,000 per year cost. The companies are already starting to hire American workers. I have a friend actually who got laid off from her job in IT, immediately found a job with one of the data centers that was there, and it was credited to the fact that it's just too expensive to hire an overseas worker now.
Yeah.
It was cheaper to hire her, and she's by American wage standards. So that's kind of a success story, I guess, of that one program there. There's definitely pockets of the East Coast that are weakening. Even where I live in Washington, D.C. is finally weakening. We probably hit our peak in May, and now you're seeing the listings come on, and they'll drop 50 grand, they drop 25 grand. So there's this a little bit of an inflection that's happening. Some of the prior hot markets, particularly in the Sun Belt, have seen double-digit drops from the peak of asking prices. Also, what's cooling is rents are starting to cool down. There's a lot of markets where we're seeing double-digit rent decreases for new listings, meaning that a tenant has moved out, the property is coming on the market, it's going to rent for a cheaper number than it did a year ago. But that's not to say that we're in a housing crash. We're nowhere close to that. So don't get any big dreams. But, I mean, think about it this way. We have somewhere around, it's like 27% of all outstanding mortgages in the United States are financed with below 3%. And it's about, it's drifting down now because we've had a couple years of higher mortgage rates, but we're somewhere in the 80% range of all mortgages still outstanding have a less than 4%. So that makes financing for those people still incredibly affordable. But the number of 6% or greater mortgages is now up to 20%. So that number is starting to climb. So that's putting actually a little bit of pressure on things. If you're buying a $1.3 million house and you're putting 20% down, you could be paying $9,000 a month between property tax, depending on your local property tax, mortgage interest, principal obviously. If you have an HOA fee, your insurance has gone up dramatically over the last several years. A lot of folks' homes have seen 50 to 100% increases in insurance. So those are all factors that are starting to weigh on the housing euphoria. All right, I'm way over time. Was this helpful?
Yes.
Awesome. Thank you.